Hey everyone, and welcome. Thanks for joining us on HR Benecast, your source for expert commentary and insights on current health benefits related news and strategies. This is your host, Mike Stahl. I don't know about you, but I certainly can't believe it. This is already our last episode for the year. And as the year ends, we're happy to report on some of our client satisfaction survey information. The 2023 survey just closed, and I know we had roughly about 150 of our clients respond, which was a wonderful participation rate. So thank you to everyone who submitted their survey. Our clients scored us on a 4.76 on a 5-point scale. So every year we try to stay above the 4.6 mark, and we've been able to do that every year that we've done the survey. And so to be at 4.76 is a wonderful testament to the work that our clients and their consultants and our team here at Employers Health do each and every year. We also want to make sure that we find out how likely clients are to recommend Employers Health to a friend or colleague. And so we track the Net Promoter Score, and I'm happy to announce that our NPS score this year is 83.67. So in terms of where others in the industry are as it relates to healthcare, we're really happy with being in that 80 to 90 range. So we're extremely proud of these two scores. Again, thank you to all of those that submitted your surveys, and certainly our team will be doing everything it can to strive to exceed them in 2024. As we reflect on the end of the year, we would also like to thank each of you for your confidence in our organization. Certainly, we couldn't do it without you. I mentioned at our Fall Benefit Forum that we had an outstanding growth year as well. So when you can add that kind of growth, again, about $500 million in new pharmacy spend this year, about $600 million last year. So that's over $1 billion in 2 years of pharmacy spend. That represents probably about 110 to 120 new clients. So when you can add that kind of growth and still generate this type of satisfaction scores, obviously we're really proud of that and really happy about it, and couldn't do it without all of you. So certainly appreciate our working relationship. Before we get started, I'm also excited to share details on our upcoming annual benefits forum, March 5th and March 6th in Columbus, Ohio. The annual benefits forum will feature seasoned pharmacy consultants, benefits professionals, clinical management specialists, and others who will share a host of topics, including real-life solutions to today's benefits issues, cost reduction methods through high-quality digital care, current congressional initiatives and their effect on your plan, and certainly they will have an effect on your plan, risk management solutions for high-cost claimants, how to enhance productivity and workplace satisfaction, particularly for working caregivers, healthcare price transparency and its impact on employee benefits, the impact of biosimilars on plan performance, and of course, the latest developments in everyone's favorite topic, the new GLP-1s for weight loss. So you can sign up to be notified when registration opens, which will be after the first of the year. And you can do that at our website, employershealthco.com/ABF. ABF is an annual benefits forum, ABF 24. Again, employershealthco.com/ABF 24. And we hope to see you in March. All right, let's get started. Joining me today is Ryan Siemers, founder and principal at Aegis Risk. Ryan is a nationally recognized expert on self-funding and catastrophic claimant risk management. He holds a certified employee benefits specialist designation through the International Society of Employee Benefit Specialists and authors the annual Aegis Risk medical stop loss premium survey. I hope you enjoy our conversation with Ryan. All right, Ryan, to get us started, maybe tell us a little bit about yourself.
Sure. I'm Ryan Siemers. I'm the principal and the founder of Aegis Risk. We're a focused consultancy and brokerage on medical stop loss. As we say, it's all we do. Obviously, stop loss is a reinsurance protection for self-funded health plans. We work either direct with an employer on their stop loss issues, or we also partner with other brokers or consultants who see value in having, in many ways, a plug-in expert on their side to help them review the market, find solutions for their groups on their own. So it's a neat little niche in the world of employee benefits more broadly. And curiously, sometimes we do say that's exactly gets around stop loss because it's actually not really an employee benefit. It covers the group and the plan sponsor, but it's within that world, and it's all that we focus upon.
Where's home for you?
Yeah, I am located in Northern Virginia.
Excellent. Well, I know we've had you in to speak before, and one of the things that we always was interested in getting out to our clients was the Aegis Risk medical stop loss premium survey. Can you tell us a little bit about the survey itself before we get into some of the findings?
Definitely. Thanks for asking. Yeah. It's an annual survey we do on stop loss premium as well as coverage provisions. This year in 2023 was its 17th year. We're quite proud of it. It does a very good job of both measuring policy premium and provisions from both plan sponsors. We also have quite a good amount of entries from other brokers and consultants, some stop loss underwriters, and some health plans. So in many ways, even before perhaps the term was popular, we like to say it's sort of a crowdsource effort within the benefits industry and from plan sponsors. It in recent years is capturing several hundred million dollars of annual stop loss premium, and capturing nearly 1 million covered employees in recent years. It is very much the survey that seems the others all leverage and depend upon as well. And it's a 4-page report. We do co-sponsor it with the International Society of CEBS. I have the designation. I was a former president of the society, actually, and it's readily available. Either you can find it on the CEBS website or request to us at info@aegisrisk.com. Readily get you a copy. It's a great survey, and it's designed to be oriented towards a plan sponsor to be able to see exactly where on the survey their premium is relative to benchmarks. Since there's not a fixed cost of a stop loss premium, it's highly dependable, obviously, on your deductible and what that cost would be.
Absolutely. So as I'm out talking to prospects and clients and the topic of stop loss comes up, it seems like most of them are buying stop loss policies directly from their medical carrier. But we know that they're not the only players in the industry. So maybe as just a little bit of stage setting here, tell us a little bit about, who are the big players in the stop loss and reinsurance markets?
Definitely. And first, you are correct. When you look at the volume of premium by the largest stop loss writers, 3 of the top 4 are Cigna, United Healthcare, and CVS, Aetna. Obviously on their own book of business. None of those really go out and write over other administrators, although they might have arms that do as such, like Optum for United Healthcare. But there's many in the market, particularly those who probably are larger and more established on self-funding, who prefer a third-party stop loss underwriter. Oftentimes, it seems in the market they can be more competitive in their rates, perhaps offer some more provisions like what's called a no new laser renewal, where they can exclude a claimant on renewal and also have a renewal rate cap. And there's also there is some value to what we call the sentinel effect. To have another set of eyes looking over your largest claimants, because otherwise, if it's directly written by the health plan, the stop loss, there's not another party looking to say, hey, was this properly paid? Are there no duplicates in this very large hospitalization bill? But direct writers, just to rattle off a few, we have direct writers. We also have MGUs that can be involved. Direct writers include some of the larger are Sun Life, Tokyo Marine, HCC, Voya, Symetra, Berkeley. All of those, if not a couple of them there, do have over $1 billion a year in stop loss premium. MGUs are another entity that managing general underwriters. That is where you might have an entity who does the sales, the claim servicing, and the support on the stop loss, but they partner with an insurance paper source, as we call it. It could be Nationwide is a common one, Zurich. Oftentimes might be more on groups that are a few hundred lives that are looking for an alternative to what their health plan may offer. And MGUs are also another source, and there's many of those out in the marketplace, regional and local as well, that play in that. But when it gets down to you look at the market, the top 10 writers are about 70% of the overall market, including the health plans I referenced before and those larger direct writers we referenced there.
Great. I think it's important for those listening. I know a lot of times when we're talking to clients about the opportunity, for example, to carve out pharmacy benefits, one of the tricks that the carriers will play is, well, if you carve it out, then we're not going to cover it under our stop loss policy. And sometimes they feel helpless. So it's good to know that there are other options that are out in the marketplace with credible carriers.
Yeah, very strong comment. And that is something that still will trigger a desire by a plan sponsor to have external stop losses. Exactly that. The pharmacy has been carved out, and it's more readily available to be underwritten by a third-party stop loss writer.
Mm-hmm. So you talked earlier about, stop loss being, highly dependent on, for example, where a client may set its deductible. And so I'm curious, as you look at the survey results from this year, what are happening to deductibles, overall as part of these policies? Are they going up? Are they coming down? Are they staying relatively the same?
Sure. Good question. And, I'd further add there's always multiple variables as to what a group's deductible might be. First of all, as everyone knows, claim dollars are getting larger. Claimants are getting larger. Just by that nature alone is causing deductibles to perhaps inch upward. But still, although it's not a 1-to-1 ratio, the size of the covered population, the number of covered employees is very indicative of where your deductible might be. So, and there's actually data that we have in our survey, referring back to that. That's another graph we have in there. So, an employer with about 1,000 employees per our survey might have a deductible around $225,000 as a specific. But employer of maybe 500 employees might be around $125,000 or $150,000. And, they're inching upward because of that. It is more difficult perhaps for let's say a first-time self-funding group that might be, say, 120 lives to perhaps get a $35,000 stop-loss deductible. That was more feasible perhaps, 10 years ago. Not as much anymore. That's unfortunately starting to approach a fully insured plan. It is an issue there. So, but the underlying cost is definitely driving up, but still, most of your groups are still perhaps below a $500,000 deductible easily. And we're seeing that consistency year over year. The premium, though, has definitely been rising.
Good. And that kind of moved into the next question that I had was about premiums and what are they doing? Obviously, like you said, there's a lot of variables that go into it. But if we try to control the variables, generally speaking, it sounds like prices are going up for these policies.
They are. And, the bottom line expense has become much larger. And several variations and several impacts as a result of that. First, although it's now been over 13 years since it was passed, the Affordable Care Act, as we remember, removed lifetime limits. That really opened the gate for, I don't want to say uncontrolled billing, but it sometimes seems that way. There used to be kind of a ceiling assumed somewhere, perhaps $1 million to most billings. It took a few years for that to work itself out into the marketplace, but now it's in full effect. We see it with the evolution of gene therapies, which we can talk about, I believe, further here, where the price tag of those therapies is now permissible because there is no dollar limit on it. But we're particularly in inpatient setting, in hospitalizations, those costs have gone up. Labor costs within hospitals and in the healthcare as a whole, like anywhere else, have been under pressure and wages going up. So that all accumulates to the average claimant catastrophic we're speaking of here, particularly with stop loss, being higher than it historically used to be, and it's seemingly having, and there's evidence at a higher level of inflation than the overall healthcare package might have that we see in the catastrophic claimants. Another dynamic we have, and it somewhat goes back to the earlier questions about what are plans doing with their deductible. If a plan does not change its deductible from one year to the next, it fully incurs leverage trend. Where we had the same dynamic with fixed dollar pharmacy copay several years ago until largely coinsurance was added. A $100,000 claim in year one might be, let's say, like a $200,000 claim over a $100,000 deductible. So there's a $100,000 reimbursement in year one. In year two could easily be $220,000 in year two. Keep the deductible the same. That's a $120,000 reimbursement. Right there is a 20% increase in the reimbursement of that claim from one year to the next due to underlying trend. So you bring that across the board, and we're typically seeing leverage trends well into the teens, if not into the 20s. Our survey actually explores that because it varies by deductible, and it gets higher as the deductible gets higher. But still, most groups, perhaps 3/4, do not want to change their deductible from year over year. They like to stay where they're at if they can. And in order to do that, typically you're looking at least a 10, 11, 12% increase year after year. And that's what accumulates to the higher cost of coverage. What's actually paid in premium as well is because groups are not wanting to move, or as we call it, index their deductible periodically to underlying trend and slightly raise their deductible.
Yeah, I'm glad you brought up the Affordable Care Act because certainly we see that in the pharmacy space in terms of limiting the total on the deductible and the max out of pocket, and then eliminating, as you said, the maximum benefit provisions of claims. And so, we see these drug prices just continue to go up and up and up, and employers have increased the deductibles, I think, pretty far, and probably as far as they're going to. And then we get these copay coupons by the manufacturers to try to shield participants from the high cost of the drug, and then they, basically stick it to the plan on the back end. So it certainly has affected us in the pharmacy space, and like all of healthcare, it's all connected. And so it also ends up hitting employers a second time as they're out shopping for their stop loss.
Agreed. Yeah. And it's still, as we said, it is pretty much, it has been the law of the land, but the Affordable Care Act. But, we're still feeling, for good and for management, I don't want to say bad, but for management, the impacts all these years later. And it's still revealing itself in some of the evolution we're seeing in underlying expenses that plan sponsors face.
Absolutely. You also mentioned the CAR T cell therapies and gene therapies, and obviously, those are going to be incurred under the medical benefits for employers, and a lot of employers are asking us, what do we do about these? And I'm not sure that the market has a really good answer to that yet, but from a baseline risk management perspective, how are these being addressed in stop loss policies? What do employers need to be thinking about or looking for in their policies as it relates to these high cost therapeutics?
Sure, definitely. No, and that's definitely obviously a very evolving concern, and it's here already since we do have several therapies already approved and at some very large expenses. And there's variation from the stop loss community. I mean, first and foremost, if not already, any plan sponsors should directly ask to their stop loss provider, are these covered? How is Zolgensma, for instance, Luxturna, are these covered therapies? At placement, ensure that they are covered. Be aware for a potential. I referenced the word laser earlier. A laser is the term used for a claimant that is excluded or put at a higher deductible by underwriting because typically there is an underlying risk and they're known to be a forthcoming claim in the future. There may not be a deductible difference, but there could, for instance, another one we have is Roctavian, which is a finally recently approved therapy for hemophilia, which could be around $3 million on its price tag. So if you have a hemophiliac on your plan who's currently receiving factor already at some expense, there might be a laser if that individual is prescribed or given a therapy of Roctavian. So be aware of that. But two, there's been philosophies from under stop loss underwriters we've seen. Some are very much looking to laser if they see any potential claimant, if they do at placement or renewal. Others are realizing, hey, these are out here, and you know what? In some ways, I use Roctavian. We might have a factor 8 hemophilia claimant that's on our books or have been on our books that's running at $1.5 million a year on a $200,000 deductible. 1.3 million in reimbursement. Yes, there might be some high renewals capped at 40 or 50%, but there's still a lot to catch up because that claimant's not going anywhere. And so they see, hey, wow, for us in our book, boy, if we could write those type of claimants off at 3 million and be largely, I'd say, done with it as far as expense, they're seeing more of an end game there. So some of your larger writers I referenced earlier do have an approach where they're saying, hey, we will take it. We have a large book. We've already actuarially predicted we're going to have 3 of those next year. And if you are one of those policyholders that happens to be one of the 3, that's where it is. Stop loss is a pooled coverage. They've already ready to accept it. Others may not have actually priced for that quite as well and might look for ways to exclude it. So it is, do your homework. And furthermore, what is very key is ensuring that every plan has a plan document, obviously, an SPD and a plan document, and you have your stop loss policy. And ideally, what we're looking for is what we call plan mirroring, where there is not conflict between the two definitions, usual and customary charges, medical necessity. And just ensure that your plan document properly covers and has the protocols, and medically necessary means if you prescribe one of these costly gene therapies, that it has gone through utilization and clinical review by the time it is dispensed. And so the health plan can show we did all of that by the time the claim hits, because that might be when stop loss first finds out about it, when it's actually being billed. And so it's very important to ensure you do have a quality plan management in place so that it is proven that this was medically necessary per the plan document and clinically covered and approved. Finally, and to that, which a lot of people have also seen, we can't talk about gene therapies and CAR T cell therapies without the carve-outs that are out there. So that is a more common. Several in the market are offering them. Where there might be those that are already approved. It could be it's a known list typically of, let's say, a dozen or so that already are in the market that says, hey, we will cover this therapy if any of your claimants get it. It's carved out, so it's no longer on your stop loss anymore. It's on this carve out. Those are great, but you still probably have stop loss in place. And so the interaction between those two needs to be fully studied and reviewed by any group looking at doing a gene therapy carve out, because your stop loss writer needs to know you have a carve out so they don't price you for that risk. But they're likely going to say, oh, we're just not covering gene therapy then. This is all on your carve out. This is great. We've got that, they're probably going to do a dollar for dollar trade off in the premium there. So don't expect, to be further savings there. But you might need to use their PBM in order to have that. That's how it is with Optum, for instance. You need to Optum, you need to have their carve out program. You need to have them on the PBM. A plan may not want that. Or later, a few years down the road, for other reasons, you decide you want to move that administration. Well, that gene therapy carve out may not be available for you anymore. Now you have to bring all that risk back into your stop loss coverage, which means a disclosure exercise and could result in some excluded claimants. So they're not as smooth as they initially sound, but they are another effective risk protection that's out there for the gene therapies.
And I think most of the PBM or carrier-based kind of carve-out programs are specific about which gene and cell therapies they cover.
They are.
I mean, what's the risk of not marrying up what you're carving out for versus, the stop loss provider saying, okay, we'll carve out gene therapies when you're actually only covering out 5 specific.
You're getting right at the heart of the matter there, is that even though the carve-out gene therapy may say, hey, we cover this list of therapies. And in many ways, they say, hey, these are the therapies we're covering for 2024. And they may say, hey, we expect these to have approval in the pipeline mid-year. At that time, we will add them. But part of with gene therapies and, the pipeline, as I referred to there, is quite full with a lot of therapies for a lot of conditions and diseases are all going to be covered by these carve-outs. None of these cover very large populations. So, the price tags are significant. The real risk of a group hitting one of these is very low, but that's not enough reason to say, oh, maybe we won't get hit with one. I mean, the impact is significant if you are caught with one of these. So, but to your end, there needs to be an integration between the two with your underlying stop loss. And that too is where, as I get back to the earlier question about some of those writers who are properly anticipating the impact of these gene therapies and their price tags in their book of business and pricing for it, in some ways are sort of the most optimal ones to be at in this case, because they know it's going to be there. And some of those writers too, for what it's worth, have clearly said in the market, look, if you catch a $2.5 million claimant on this gene therapy, and your annual premium is only $500,000 a year on stop loss, we're not forever holding you in debt to us. They're like, that's a hit to our book. Your renewal will otherwise proceed normally, and not due to the fact that you were the one that caught that claimant.
So as we wrap up here, when you're out talking to clients about their policies, what are some of the others? We've talked about, indexing deductibles, and we've talked about CAR-T gene therapies. We've talked about the different players that are in the marketplace. What else? What else should employers be thinking about in terms of key considerations given the current market?
Yeah, and kind of in some ways, going back to a few of the comments earlier, is ensure, first of all, in talking stop loss deals with the catastrophic claimants, that you've got, quality claim review and utilization management within your plan, and plan document language that spells that out clearly, and that it integrates or mirrors with your stop loss policy so that there's no dispute there between the two. But we do, and this may go a little bit beyond stop loss, but it still does. And the stop loss writer will seek to do this as well. But there is definitely opportunity for abuse on the higher dollar claimants in particularly an inpatient setting to be the source of a lot of revenue for that facility on the shoulder of your plan, and ensuring that you have those bills being reviewed properly and fully. And that first and foremost should be done by your health plan administrator. Your stop loss administrator too would want to see, can we have a copy of the hospital billing, so we can take a review and make sure that everything was handled properly. But just ensuring you've got that, you have that proper, cost and clinical management on your plan in your document, and that it flows through to your stop loss, and ensuring if you are getting, value there, sell that story. One of the things that's interesting to me with stop loss is it is an actively underwritten risk. It's not formulaic. It is in some cases because everything works off of the same, is what they call it, manual rate, and then that getting back to that pooled book of business and what they need. But then you're trying to argue yourself as a discount from that manual rate, and that is where you're able to sell successes you've had elsewhere, where your costs are relative to benchmark, efficiencies you've had. This isn't a passive situation any plan sponsor needs to be in, particularly when, and everyone at Employers Health knows this well, that healthcare is it's 20% of our economy now, and a big funder of that part of the economy are private health plans, and it needs to be monitored and managed. And when they get very big, the stop loss is a key part of it, to make sure that the plan is properly covered and able to anticipate, and as it is, budget for it.
Excellent. Well, I really appreciate, Ryan, you sharing the information with us. I know it's a lot of information coming at our listeners in a short time period, but I think all very worthwhile and definitely very relevant in today's marketplace. I know that you're planning on joining us in March at our annual benefits forum here in Ohio. We're looking forward to hearing more about survey results and other stop loss happenings. Anything else you plan on covering, or that attendees should expect to hear?
Yeah, definitely. No, looking forward to it and appreciate the opportunity to present at that meeting. What we're looking to do is, with some visuals, perhaps speak better to what we just talked about today there. And, we'll talk about, create some awareness of those current and evolving catastrophic claimants in the marketplace, including the gene therapies, those in the pipeline, and as we've referenced a few times here, sizable inpatient hospitalizations that are out there. It's always good. We never take an expectation that stop loss is a coverage that everyone knows really, really well. They generally don't, and that's okay. It kind of gets back to that it's really not a benefit argument. But, we'll make sure we'll talk about key policy provisions. I referenced no new laser with renewal rate caps, that type of provisions that folks can look for. Plan mirroring as another, standard to shoot for within your policy. And then, somewhat wrap that up with, how to put those into action on your next renewal or market bid you might have to place coverage, or if it's the first time as you look to place your coverage potentially with a third-party underwriter, to perhaps give you more flexibility with your plan. And as we said, too, some of that sentinel effect that stop loss can provide on your largest claimants. Leveraging our survey data. We've got a lot of good graphs that came out of that and described earlier how to get a copy, and always great to use that as well.
All right. Well, we certainly appreciate you being with us today for the podcast, and look forward to having you with us in March.
Looking forward. Thank you.
Thank you to Ryan. And I think this is such an important topic for employers, especially as claims and costs continue to grow. Again, you can hear more from Ryan at the 2024 Annual Benefits Forum, where he'll present on medical stop loss and risk strategies for catastrophic claimants. The website, employershealthco.com/ABF24. You can visit that and learn more. Before we go, I want to thank our sponsors for helping to not only make this podcast possible, but for supporting us and providing great employee benefits related content. Thanks to annual supporters CVS Health and OptumRx, and our executive supporters Delta Dental, the Diabetes Leadership Council, Hello Heart, and Pfizer. Visit employershealthco.com/supporters for a full list of sponsors. There's always something new at Employers Health, so be sure to follow us on our social media accounts, including LinkedIn and Twitter, to stay up to date. And be sure to subscribe to HR Benecast to be notified when the latest episode is out, so you can listen in on our most recent conversation with an industry expert. That'll wrap us up for this month's episode. If you have suggestions for a future episode or a question that you'd like answered, please let us know. And thank you for taking the time to listen and for your continued support, participation, and interest in Employers Health. We look forward to a great open enrollment season and implementation season. Again, do not hesitate to reach out should you need help, and also have a very healthy and happy holiday season and a fantastic new year. Be well, and we'll see you in 2024.